Most financial advisors give the same generic advice to almost everyone. Work until 65. Work until 67. Wait as long as possible, just to be safe. That advice isn't wrong exactly, but it's built for the average person, not for your specific numbers. And there are real measurable signs that some retirees hit years before their advisor even brings up the topic seriously, simply because nobody sat down and ran the actual math against their situation. The truth is, "You're not ready yet" is often just the safest thing an advisor can say, because it protects them from liability if things go wrong, and it costs them nothing to say it. It's rarely based on your actual numbers, your actual expenses, or your actual guaranteed income. Some people are genuinely ready to retire 2, 3, even 5 years earlier than they've been told, and they never find out, because nobody walked them through the real financial signs that matter. In plain terms, they could actually check for themselves. In this video, I'm going to walk you through 5 specific financial signs that suggest you might be ready to retire sooner than conventional advice suggests, plus one detail that matters just as much as all 5 combined once you actually get there. Real math, real thresholds, not vague reassurance, and nothing you can't check against your own account statements this week. By the end, you'll be able to check your own numbers against each one and see exactly where you stand, instead of relying on someone else's general rule of thumb. Quick disclaimer first. I'm not a financial advisor, a CPA, or an attorney. This video is educational only, meant to help you ask better questions. Always confirm your specific numbers with a licensed financial advisor before making a retirement decision. My name is James. This channel breaks down exactly how Social Security, Medicare, and IRS rules affect your retirement income every single week, using real numbers instead of generic reassurance. If that's useful, subscribe now. Next week, I'm covering the exact healthcare bridge strategy retirees use between early retirement and Medicare, including how premiums typically change as you get closer to 65. Quick question. What age are you hoping to retire? Drop the number in the comments right now, and I'll tell you which of today's 5 signs to focus on first. Let me introduce you to Mark. Mark is 58, works in logistics management, and has been told by his advisor for the last 3 years to keep working a few more years to be safe. Every meeting ends the same way, a vague reassurance without a real number attached to it. Mark has never actually seen his own numbers laid out against clear thresholds he could check himself. Let's check his situation against all 5 signs and see what they actually say, one at a time. Here's sign number 1. Your portfolio already covers 25 times your annual expenses. This comes from what's known as the 4% rule, a widely used guideline suggesting you can safely withdraw about 4% of your portfolio each year without running out of money over a typical 30-year retirement. If your annual expenses are $60,000, that means a target portfolio of roughly $1.5 million. Mark's expenses run about $55,000 a year, and his combined retirement accounts currently sit at $1.4 million. He's essentially already there, sitting right at the edge of that threshold, something his advisor had never framed in those specific terms, choosing instead to simply say, "You're getting closer," without ever naming the actual number he was getting closer to. It's worth noting this rule was developed decades ago using historical market data, and some analysts now argue a slightly more conservative withdrawal rate makes sense for anyone retiring especially early, since their money needs to last longer. Here's sign number 2. You have guaranteed income that covers your essential expenses, regardless of what the stock market does. This typically means Social Security, a pension, or both, adding up to enough to cover housing, food, utilities, and insurance without touching your investment portfolio at all. This matters because it means a bad market year doesn't threaten your basic ability to live, only your ability to spend on extras. Mark's projected Social Security benefit at 62 is $1,800 a month. His wife's is $1,200. Combined, that's $3,600 monthly, almost exactly matching their essential monthly expenses. That means market downturns wouldn't threaten their ability to keep the lights on, even in a genuinely bad year for their portfolio, which is exactly the kind of security that generic "just wait" advice rarely takes the time to actually quantify. Here's sign number 3, and this is the one that trips up early retirees more than any other. You have an actual healthcare bridge plan mapped out before Medicare eligibility at 65. Medicare doesn't start until 65, and for anyone retiring earlier, that gap has to be covered somehow, either through COBRA continuation coverage, a spouse's employer plan, or marketplace insurance purchased directly. According to recent industry data, a typical 64-year-old retiree can expect to pay somewhere around $8,600 a year in premiums for coverage during that bridge period, and that's before accounting for deductibles, copays, or prescription costs. Mark is 58, meaning he'd need roughly 7 years of bridge coverage if he retired now. Multiply that annual premium out over 7 years, and it becomes a real six-figure line item that has to be built into the numbers, not treated as an afterthought or assumed away. Some retirees offset part of this by picking up part-time consulting work solely to access employer health coverage during the gap years, which can meaningfully change the math without requiring a full return to a traditional job. Here's sign number 4. You're debt-free, or close enough that your major monthly obligations are essentially gone. A paid-off mortgage changes the entire retirement math because it removes what's usually the single largest fixed expense most households carry, sometimes $1,500 a month or more, freeing up cash flow that no longer has to come out of a shrinking portfolio. Mark's mortgage has 3 years left on it. That's a real factor pushing his actual ready date later than his portfolio numbers alone might suggest. And it's a detail that matters more than most people realize when comparing their situation to generic advice that doesn't account for it at all. Some retirees choose to pay off a mortgage more aggressively in their final working years, specifically to remove this variable before their retirement date, even if it means temporarily reducing other savings contributions. Here's sign number 5. Your money is spread across different tax types, giving you flexibility in retirement instead of one single rigid pool. That means a mix of traditional pre-tax accounts, Roth accounts, and regular taxable brokerage accounts. This matters because it lets you control your taxable income each year by choosing which account to pull from, potentially keeping you in a lower tax bracket and avoiding surprises tied to Medicare premium thresholds down the road. Mark has almost everything in a traditional 401k, with very little in Roth accounts. That's a gap worth addressing, ideally years before retirement through partial Roth conversions during lower income years, not the year of, when there's far less flexibility to smooth things out. Let's put Mark's full picture together. His portfolio is nearly at the 25 times expenses threshold. Sign 1, close. His guaranteed income nearly covers his essential expenses. Sign 2, close. But his healthcare bridge isn't planned yet. Sign 3, not ready. His mortgage still has 3 years left. Sign 4, not ready. And his accounts aren't tax diversified. Sign 5, not ready. 3 out of 5 signs are close to ready. 2 clearly aren't yet. That's not a vague, keep working to be safe. That's a specific, roughly 3-year runway with clear targets to hit on the 2 remaining items, which is a very different conversation than the one his advisor has been having with him for the last 3 years. To be fair, generic advice exists for a reason. Most people genuinely aren't ready as early as they think, and a cautious advisor recommending you wait is often protecting you from a real risk, not just covering themselves legally. Sequence of returns. Risk is real. Unexpected healthcare costs are real. And living longer than you planned for is increasingly common as life expectancy trends upward. These 5 signs aren't a guarantee, and they're not a substitute for a full financial plan built with a professional. They're a framework for asking sharper questions and getting real numbers instead of a vague not yet that never gets explained. Here's a bonus consideration that doesn't fit neatly into the first 5 signs, but matters just as much. How you'll actually spend your time once the structure of work disappears. This isn't a financial number you can plug into a calculator, but retirees who haven't thought this through often end up either going back to part-time work out of boredom or spending significantly more than planned simply to fill the extra hours. It's worth having a real answer to this question before you finalize a retirement date, not just a financial one, because a portfolio that technically supports early retirement doesn't automatically support a fulfilling one. Here's a detail almost nobody talks about. Even if all 5 signs check out, the sequence in which you draw down your accounts matters just as much as having the money in the first place. Pulling too heavily from tax-deferred accounts early can push you into a higher bracket unnecessarily and trigger larger Medicare premium surcharges later, while pulling from taxable accounts first can preserve tax-advantaged growth longer and keep your reported income lower in the early years. Some retirees use a bucket strategy, splitting savings into short-term cash, medium-term bonds, and long-term growth investments, specifically to avoid being forced to sell investments during a market downturn just to cover living expenses. The order of withdrawals, and the structure behind them, is its own strategy, entirely separate from simply having enough saved in total. So here's exactly what to do. First, calculate your own 25 times expenses number and compare it honestly against your current portfolio balance, rather than relying on someone else's rough estimate or a generic percentage. Second, add up your guaranteed income sources, Social Security, and any pension, and compare that total directly against your essential monthly expenses, not your full lifestyle spending, since the 2 numbers tell you very different things. Third, if you're planning to retire before 65, price out your actual healthcare bridge options this year, not the year you're ready to walk out the door, because premiums and plan availability can shift from year to year. Fourth, if most of your savings sit in one single tax type, talk to a professional this year about whether partial Roth conversions during your remaining working years could give you more flexibility later. Fifth, write down, in plain words, what an average Tuesday in retirement actually looks like for you. because a financial plan without a life plan attached to it tends to fall apart within the first year or two. If this helped you see your own numbers more clearly, share it with a spouse or a friend who's also been told to just wait a few more years without ever being shown why. It's a 5-minute conversation that could save someone years of unnecessary work or years of unnecessary risk, depending on which direction their real numbers actually point. Drop your target retirement age in the comments, along with which of these 5 signs you already have checked off. I read every single one, and it helps me know exactly what to cover in future videos. If this helped you, hit like and subscribe, because I break down exactly this kind of practical retirement math every week, using real numbers instead of vague reassurance. I'll see you in the next one.